Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's episode, I'll continue talking about DCF models, the free cash flow discounting model, and how you get the cost of equity with the CAPM. So I'll do a small review. Last time we did all of this big equation just to get to the cost of equity. And the cost of equity, we would fit it into our equation of the WACC, and we could get the WACC. So after we find the WACC, this is going to be the important part, then we have to estimate the future cash flows of the firm. First thing that I told you could do with either Capital IQ or other financial analyst companies that are estimating this day to day in their full-time job. And then you can get, second step, the free cash flow of the firm for some years. So you can start analyzing it, taking those values, and then the last thing that you would need is the perpetual growth rate for the years that are to come. So analysts are usually estimating the free cash flow of any firm, let's say of Apple, but they're only going to do it up to a certain point. Then they're going to say from 2030 and beyond, Apple's going to continue growing at a rate of 5% every year, or 2% every year, or 10% every year. So you can also find what analysts are saying about this. Usually you can also see at old company growth, maybe that might be a benchmark. You can decide where to figure out this growth. But then, after you have all of this accounting parts of the equation, you can discount all of the free cash flows of the firm with the WACC. Discounting, again, remember, means bringing all of that to present value. So we will take all of the free cash flows that you have, we'll discount them each period, and then for the perpetual growth rate, we'll use the perpetuity formula, which means cash flow over the discount rate, in our case it would be the WACC, minus the growth rate, the perpetual growth rate. And this is going to give us the value of the perpetuity one period before it starts. So be careful with this. Many people mess up with this equation. If I estimate that from year 2030 and on, Apple's going to be growing at 10% a year, and I use this perpetuity formula, and then the value I get will be from 2029, not today. So I still have to discount it back up to all of my years. So you have to make sure you discount the perpetuity and you discount all of the free cash flows of the firm, but then with the WACC, all of that would give you the present value of the firm. So ta-da, now you have how much is a company worth today. But that company worth also includes its debt. So that's one part that you have to remember. Always take away the debt, because now you're going to look only at the equity part. And so you have to take the equity and divide it by the number of shares, and you have a fair price per stock. This is a very long process. So many people wonder, is it worth it to do it? And one of my favorite books, The Intelligent Investor, that kind of explains also all of these models. He gives a couple formulas. He says, if you're not willing to do this, then you can just be a passive investor and you can invest in the market. So that's very easy to do nowadays with an ETF or something like that, and not worry about analyzing a firm. But if you want to analyze them with rigor and the amount needed from looking into a firm and knowing if its value, it's well priced, or if it's mispriced, it's going to take a long time. So that's what people that are working full-time doing valuations are doing. And, well, we have to consider, is this model useful? Is the CAPM useful? First, I told you this is a very defensible way to estimate the cost of equity for most securities. It's not going to work for gold, for example, or very specific things, maybe Bitcoin. It won't work. But it's going to help us for most securities. It's also very useful for capital budgeting. So not all companies that are analyzing stocks are doing this. Companies that are planning on a big project and they want a positive NPV, like I mentioned in one of my first episodes, they're going to use the CAPM to get the cost of equity, maybe the WACC. This is going to lead into many processes. And then it's also very useful for evaluating portfolio performance. So there are many people that are, as the website's called, seeking alpha. So alpha is going to be the realized return that you got minus the expected return. So many companies do all of that calculation to know what is the expected return, and as soon as they have that number, they want to create even more. If you can manage to find a difference between the one that you had expected and the one that you actually had, that means that you had a positive alpha. And so in competitive markets, if you've been studying economy, you may think that this makes no sense because markets are efficient. The thing is, markets may glitch for a second. As I said in another of my episodes, a glitch in the matrix, arbitrage opportunity comes up, you're going to take it, and someone may have a negative alpha. Someone may be down performing or be performing worse than the market, and you're going to take away their loss, hypothetically, into your own gain. So that's why some people are able to achieve positive alpha. That's because basically all of the rest of the market that didn't, it's doing negative alpha. So alpha is a very important measure in all of the portfolio performance firms. So they're always going to use this CAPM model into measuring their expected return. But what can we say? This model doesn't fully predict the returns for certain stocks because it's simple. You're only taking beta, which takes the market risk, then multiplying it by a market risk premium, and then you already have your cost of equity. So when does CAPM not work specifically? There have been many demonstrated cases where it's not the best model to use, and those are specifically small stocks, because those are stocks that have lower market value of equity, and historically they've been outperforming this. Then also value firms. So I was just talking about the intelligent investor. Benjamin Graham is the father of value investing. And this means that a value firm is one that has a high ratio of book equity to market equity. So you can always compare what is the equity of a company in the books, in their financial statements, versus what is their equity in the market. And if you have that ratio to be high, it means that that is a value firm, and those are the ones that Benjamin Graham loved and that Warren Buffett loves. Those are the ones that have been outperforming the market. Then the opposite of that would be, it's actually a funny name, they're called growth stocks. And so growth stocks, people believe they're going to be the fastest growing ones, but it's actually called growth because the market is putting so much expectations on them that they are putting lots of market equity, but then they don't really have as much book equity. So the ratio is going to be smaller, and it's demonstrated that growth stocks don't grow as much as we're supposed to. Maybe growth stocks may be a synonym for overpriced stocks, and that's one of the reasons why it doesn't work. But the thing is, historically, value firms have always outperformed. The third type of firms that are always outperforming this CAPM model are the momentum stocks. And I don't know if you've heard about momentum, but this basically means that winners continue to win and losers continue to lose. So these companies that have had high recent returns are going to keep on having them at least for 6 months more or so. So winners will win and losers will lose. All of this momentum stocks will keep outperforming. So these three, small stocks, value stocks, and momentum stocks, all of them performed better than what CAPM could predict, showing that there are other factors that we are not fully accounting for, and they are affecting the expected returns. So some economists that were doing this started studying this, and they developed a new multi-factor model, and this is called the French model. Of course, developed by an economist whose last name was French. So this one won't only include the market risk premium, for which we used beta last time, remember, but it's going to include other two factors, and then we'll talk about a third one that was added. But they included one factor for size factor risk premium. It's called an S. They also included a value risk premium that's called H. And then over the years, people kept saying, oh, but 3 isn't enough. Let's add a fourth one. So they added momentum factor risk premium. All of these companies that were outperforming, they were later added into the interpretation. So last episode, I told you when a market has a beta that's above 1, it means that it's riskier than the market. Below 1, it means it's less risky than the market. And then equal to 1 would mean that it's behaving exactly as the market. What are those 3 new measures accounting for? One of them, it's the size risk premium. So if this measure is above 0, if it's a positive number, it's going to mean the portfolio behaves like a smaller firm, and then therefore it will have like a premium over its return. If it's negative number, it behaves like a large firm, so it will be a smaller number. Then the value risk premium is going to mean that if this number is positive, the firm behaves like a value firm, and if it's negative, it's going to behave like a growth one. And lastly, the momentum risk premium, it's going to mean that if this number is positive, you're probably guessing it, it behaves like a momentum firm, which means it was a winner, it will keep winning. But if it's negative number, it's going to mean that the portfolio had done poor recently, and therefore it will continue to do poorly, at least for the next 6 months. So this is going to be the new model that's being used mostly for academics as well. And you can find all of these numbers of betas in the French website in case you would like to do those calculations. The thing is also, we have seen that ETFs are already taking up these models, and they're creating portfolios that are replicating these models. So what would be the last takeaway that I would like to give you in this moment would be how to invest according to the modern portfolio theory. But for keeping up the suspense, I'll talk about that on my next episode.